particularly for savers, is really, truly ugly.
So
would appear to me that people have been inured living through 40 years of very benign economic conditions not to expect inflation. We've seen a circumstance where inflation and where the interest rate has fallen for 40 years. We have come to believe in the Fed put. We have come to believe that Mr. Powell and his predecessors were more important to our financial well-being than our own efforts and our propensity to spend. And I think the consequence of that is that people have ignored the arithmetic of basic inflation. People have ignored the warning signs because they haven't experienced inflation for 40 years. Just as in the 80s, when inflation was on the decline, people's expectations were formed in the 70s. And so people were afraid of inflation for 10 years after one would suggest that the inflation dragon had been slayed. The circumstance that we have now, I think, is that people have come not to expect inflation. And so even though the warning signs are in place, hell, the warning signs, the arithmetic, even though the arithmetic and the evidence around inflation are in place, people have been conditioned by 40 years not to expect it, and it will certainly surprise them.
Well, I just want to share with you a quote from Jeremy Siegel of Wharton, who is generally positive when it comes to market forecasts. He's now warning of a painful quarter for Wall Street. He says, we're headed for some trouble ahead. Inflation in general is going to be a much bigger problem than the Fed believes.
Maybe a bigger problem that he suggests, given that he's worried about a quarter. I'm worried about 5 years and 10 years. I think we've become inured, among other things, to the drama, which is what causes us to think about quarters. If you think about the arithmetic around inflation, Daniela, think about it from the perspective of the saver. The US 10-year Treasury generates 125 basis points, which means the government pays you 1.25% a year to borrow your money for 10 years. The government's own statistics suggest that the purchasing power of the currency that they're paying you back in is declining by 5.5%. So over the course of 10 years, you experience 4%, well, 4.25% negative yield, which is to say at the end of 10 years, over 60% of your purchasing power is destroyed. I'm not worried about the quarter. I mean, for myself, I'm not worried about anything. For the length and breadth of American wage earners and savers, and for the strength of the US economy, I'm plenty worried because the arithmetic around inflation, particularly for savers, is really, truly ugly.
So what should the Fed do here? We talk about taper or not to taper. Is there a third solution we're missing here?
I think as the economy is currently configured that there isn't. You'll recall a year ago, you and I visited on this topic, and we talked about the fact that the Fed is between a rock and a hard place. They have been the market and the economy's instrument of last resort. In other words, we have decided as a people that we're not going to have hard times anymore. And the consequence of that is that whenever hard times appear, we solve them by counterfeiting. The way that you get out of this circumstance is to spend less, which isn't politically tenable, allow interest rates to be set by the market, which is to say that you don't subsidize idiotic activities with low interest rates, and you dismantle some aspects of an unfunded service mechanism. At the federal level, there's $150 trillion in on-balance sheet and off-balance sheet liabilities. Something like 120 trillion of it is in trust funds and entitlements. And you need to deal with that at some point in time. But I don't think there's the political will in place. So when I say the Fed is between a rock and a hard spot, the very low interest rates that they've promulgated is one of the things that has put them in the place they are now, and is one of the drivers of inflation. but it would be very difficult for the economy to stand higher interest rates. Let me give your viewers one example of that. Traditionally, the yield on the US 10-year Treasury has been positive. That is to say, there has been a positive yield, a real yield on top of inflation. If, as the federal government suggests, the current rate of depreciation of the dollar is 5.5%, that would suggest in a free market that the interest yield on the US 10-year Treasury would be at least 6.5%, which means that the interest charge that federal, state, and local governments, never mind consumers, would pay would quadruple. That would do an interesting thing to the deficit, wouldn't it? Perhaps more concerning to your audience, traditionally over 4 years, the yield on the 30-year fixed mortgage rate has traded at a premium coupon to the US 10-year. So imagine what would happen if the 30-year fixed mortgage rate went from 3.25 to some number like 7.5. Housing would certainly become more affordable, but I don't think that the economy would like it.
And we'll talk about real estate in a second. But I love how you said that, Rick. That there's so much truth in that statement, that we don't want to accept hard times, and we'll do anything to avoid it. Do you think that the Fed knows that they're in a rock and a hard place, as you say? Are they more concerned than they're letting on?
I think they must be. While I don't like what it is that the Fed does or how they do it, I believe that those are very smart people who understand the workings of the economy and they understand the realities of politics. I think they absolutely positively know that they're between a rock and a hard spot. And they hope or pray, perhaps if they're religious, that they can work their way out of it. Stalling has been a wonderful technique for 10 years. Kicking the can down the road has been a wonderful technique for 10 years. At some point in time, you run out of patience in the market. At some point in time, Wall Street decides that they aren't going to play chicken with counterfeiting and artificially low interest rates anymore, and they're going to go to the mattresses.
Okay. So I want to bring up sectors now, right? We've talked about gold. So here's my question to you now. In the 1970 style inflation, we saw the rush to gold, how people were turning to precious metals. Why are we not seeing that yet today? Is it because people haven't bought the inflation story yet, or are people looking to Bitcoin today rather than gold?
I was going to ask you that, Daniela. You're a journalist. I'm just a loan shark. I have three possible explanations. I think that the biggest competition that gold faces is the S&P 500. People, including Warren Buffett, believe that the finest corporations, the finest private businesses in the world have sufficient pricing power, that they themselves are good inflation hedges. Buffett perhaps proved that in the decade of the 1970s. I would tell some of your listeners, don't try this at home. He's a pretty smart guy. But I think that the biggest competition that gold faces among retail investors is the S&P 500, or for the more speculative elements of your audience, the triple Q, the technology stocks. For family offices, when I pose this question to them, which I do frequently, most family offices have been taught over the last 40 years that the way you defeat inflation is to buy fairly high quality real estate with long-term fixed mortgages. The idea being that inflation raises the cost of new construction. Taxes and fees on real estate only go up, and you can raise rents a little bit, but your cost of capital stays firm. So if you have a 30-year fixed rate at 3 and change, which stays intact for 30 years, and your rents increase at 3 or 4% per annum, the delta between the return on capital and the cost of capital helps you keep pace with inflation.